So recall our story so far. So what we observed beginning in the 1960s is that the scale of transactions in the international capital market had grown a lot since that time, right? So essentially what happened is that countries reduced barriers to private capital flows occurring across their borders. And there were important reasons why that happened, right? So one of the main changes that happened is that you had more and more adaptation of flexible exchange rate systems, and that actually allowed countries to reconcile this open capital markets with this domestic monetary autonomy that you have, right? The other factors that accompanied this increase in this size of this international capital market was the growth of international trades in goods and services that you had across different countries, the corporate activity becoming more and more multinational in nature, as well as different banks trying to escape their different internal domestic regulations by trying to participate in different activities abroad, right? Now, accompanying this increase in international capital market size is now actually a greater financial fragility in the system, right? So where is this financial fragility coming from? This is basically a result of the world financial system becoming vulnerable to bank failures on a larger scale, right? So in order to understand why this is happening, let us recall the basics of banking and the reasons why we have studied before, that how can banks run into trouble, right? So when does a bank fail? So a bank fails or basically declares bankruptcy, if you remember our way of thinking about it, when it is unable to actually meet its obligation to its depositors and other creditors, right? So how do banks fail on their obligations? Remember that banks basically use funds that the depositors have kept and the funds that they have got by borrowing money to make loans and to purchase other assets. Now, the loans that they have extended to different people, suppose that the people are unable to pay back these loans, right? In this case, what you will have is that the bank's assets may decline in value. And as a result of that, banks may basically be unable to repay back the short-term loans that they have actually issued, right? So what you end up with is that the bank's financial health is going to depend on the depositors and others creditors' confidence in the value of its assets, right? If the depositors believe that the bank's health is sound, then they're okay with keeping the money in these banks, right? And they're okay with giving loans to these banks. However, if they start becoming concerned that the bank's financial health is in trouble and the bank may not be able to repay back the deposits that they have kept or the loans that they have extended to the bank, then they may actually have an incentive to withdraw their fund, right? And in this situation, banks may end up with bank runs, which basically means large-scale withdrawal of deposits at the same time, right? And the problem happens from this liquidity mismatch in the sense that the deposits can often be something that can be withdrawn at short notice, whereas the bank assets, namely the loans that the banks have extended, are actually things which are for more long-run phenomena, right? So as a result of this, you have got the possibility of the bank failure from happening. And the interesting thing is that, the bank failures need not be happening to only banks which are actually been engaging in unsound financial loans that they have been giving out, right? So even if a bank is perfectly healthy, if enough people believe that the bank is in trouble, you may have a situation where you have this bank failure happening, right? So this is something that is would be of concern to the banks, right? Okay, so now once a bank in a financial system is in trouble, other banks which are part of that financial system may also get into trouble, right? Why is that the case? Because you have got banks lending to each other. So suppose that you have got bank A and B, where both of these banks have lent to each other, and bank A is in financial trouble because of the reasons we talked about. Now, people will start becoming worried about bank B also, because they understand that bank B has given loans to bank A. And if bank A is in trouble and ends up declaring bankruptcy, then bank B might also be in trouble because they may not be able to get back the loan that they have given to bank A, right? And so people might be concerned about the deposits they have put in bank B. And as a result of that, they may also try and withdraw their money from bank B. And that can also lead to a bank run in bank B, right? So as a result of this, you can see that problem in bank A has now spread to problem in bank B, even though bank B on its own may be still sound, right? So you have got this basically this domino effect that comes around because banks are highly interconnected, and that may actually lead to a systematic banking crisis, right? Now, whatever we discussed about can happen in domestic context as well, but we'll see later on that these things become even more plausible when you have got banks partaking in activities in different countries, right? So what are the precautions that the banks may take on their own or the government may impose on these banks, regulatory requirements in order to prevent these bank failures? Well, there are different kind of safeguards that are there. So one may be that you may have some sort of deposit insurance, which means that the people who have put money in the bank, they are assured by the government that even if the bank actually ends up declaring bankruptcy, at least a certain portion of it is insured in the sense that the depositors will get back that particular amount of money, even if the bank ends up declaring bankruptcy, right? You can also have some sort of reserve requirements, right, which would include the forcing the bank to hold a portion of assets in a liquid form. Remember that the trouble of the bank starts from the fact that you have got assets which are illiquid versus deposits which are liquid, right? Now, if you force the banks to hold a certain portion of their assets on their balance sheets in liquid form, this actually helps the bank to actually, if there is some withdrawal, they can actually liquidate some of these assets and use that to pay back the deposits without getting into trouble, right? You can have banks being asked to maintain a certain amount of capital, okay? And also you can have restrictions from the government on the banks about holding assets which are too risky. So all of these things actually help. You can also have supervisors having the right to examine the bank's books so that banks may be constrained about partaking in certain activities. You can also have banks basically being able to borrow from central bank, which means that if suppose that the depositors are worried that the bank may not have enough money to kind of like being not bankrupt, then if they know that you have got the central banks which are ready to help out the banks in terms of trouble, then they may be reassured that okay, our money is safe, right? So that may actually help to prevent the bank run in the first place, right? So this presence of the central bank from being there to help out the banks in case of trouble is what is known as the lender of last resort, right? And of course, you can have the government can or step in to restructure the banks and have different bailouts, right? So these are the common tools that are used to guard against this sort of bank runs, right? But what we observe is that these tools are important because banks may take precautions against bank failures on their own, but in the absence of regulations, they may engage in activities which are much more riskier than what is optimal from the society's perspective, right? So these regulations actually help to prevent more risky undertakings, right? Now, the problem has been that once you have got this internationalization of this banking activities, that has actually led to a weakening of this regulatory activities, just as we talked about, right? So as a result of this global financial interdependencies, now there has been a need to rethink about what are the effective ways of safeguarding against this sort of like banking crises, right? So firstly, let's think about why the traditional measures do not work that well. So we have got this as a result of this banking taking place in different countries, you have got a higher level of interbank deposits, right? So where you have got deposits of banks in country A as part of balance sheet of banks in country B and so on, right? And what that means is that you may actually have now problems in a bank of a different country. And if that is also part of your balance sheet, then that can actually lead to a transmission of problems to another country, right? Because you have got this connection happening through the different banks' balance sheets, right? And as a result of this, a localized disturbance in one country can actually set off a banking panic on a global scale, because now as a result of this interbanking deposits across different countries, you have got that the balance sheets of different countries are actually kind of like closely linked together, right? And in fact, this is one of the things that happened in the 2007 to 9 global financial crisis that we have talked about before, where if you remember, one question to think about was that how did you have problem in housing markets in one part of the United States, leading to a global financial crisis happening right across the globe, right? So this is one of the reasons why that happened. Okay, and why are international banking systems harder to regulate? Well, we can get an idea of that by thinking about the different safeguards that we just talked about. How do they actually run into trouble when you have got this international linkages, right? So remember that the first safeguard that we talked about was the system of this deposit insurance, right? Where you have got that the governments are insuring depositors against losses up to a certain limit. Now, once you have got international banking taking place, then it becomes very hard to do this deposit insurance, right? Because then it would, for example, mean that an American bank is saying that, okay, we are actually going to have deposit insurance for Greek for a bank which is operating in Greece, right? So that's unlikely to happen, right? Then the second regulatory thing that we had was this reserve requirements, right? This again becomes harder if you have got banks engaging in different countries, because you cannot have any country on its own imposing international reserve requirements on its own bank's overseas branch, right? So you need a cooperation of these different countries to make sure that these reserve requirements are now met when you have got a bank having different branches at different places, right? Then we had this idea of like asset restrictions, or what type of things the banks have on their balance sheets, or the examination of the bank's books by different regulatory authorities to make sure that they are meeting the capital requirements. So again, this becomes much more harder to actually enforce in an international setting where you've got banks taking place in different entities. And interestingly, a lot of banks actually got interested in doing these international transactions in the first place in order to avoid these regulatory requirements, right? So you've got basically different countries having different requirements. So the banks would end up like doing more activity in places where you had less regulatory requirement, because then they could partake in more risky activities, and that led to higher profits, provided things worked out well, right? The downside is that if things do not work out well, then it becomes much more difficult to actually control the problem from that happening, right? Then we talked about the central banks acting as lender of last resort. But again, if you have got banks taking place, activities taking place in different countries, then there's often uncertainty over which country's central bank is going to help out by providing this lender of last resort assistance. And are there any central banks which actually is going to help out, right? And again, when you are talking about these bailouts and all these other things, it's easier to do these bailouts if you have got a domestic bank involved. But if you have got different banks of different countries which are involved, then again, governments are hesitant to act on their own to help out a particular bank, even though it might be leading to a banking crisis, right? So you require much more cooperation in order to have this rescue or reorganization, right? So all of this kind of leads to this financial trilemma, right? Which actually constrains what policymakers in an open economy can achieve. And this financial trilemma basically says that at most two of the following three are simultaneously possible, right? So notice that all three are desirable for different reasons, right? So you want financial stability. You also want control over the different financial safeguard policies in the sense of these different regulations we talked about. But you also want to allow for this freedom of international capital movement, because then you have this opportunity for different benefits of portfolio diversification and all of these things, right? So ideally, you want all three, but because of the reasons that we talked about, it's actually not possible to have all three at the same time, right? So typically, at most, two of the three can be achieved, right? And then there needs to be a policy discussion about what are the things you want, right? So, for example, you can have financial stability and freedom of international capital movements, but then you end up losing national control over what are the different regulations that you can impose on the different banks, right? So you need greater cooperation among different countries, right? You can have financial stability and national control and sacrifice this international capital movements, but then you end up losing the benefits of this international portfolio diversification and so on, right? And you can, of course, have these two, but then that will mean that your system is subject to more and more financial instability over time, right? So you can also have like often this reforms taking place in the international financial system. So for instance, the severity of this global financial crisis that we talked about led to countries coming together and trying to come up with a tougher set of this capital standards and regulatory safeguards for international banks. So you might have heard of this name Basel III in regards to this. You can also have Financial Stability Board, whose job would be to monitor the global financial system and make recommendations for global policy coordination and reform. And there was also a change in the approach when it comes to these regulations. So rather than thinking about whether each of these individual financial institutions on their own were secure or not, one started taking seriously this interlinkages between financial systems operating across different countries and thinking seriously about the different contagion, right? Namely, if you have problems in one area, how does that problem get transmitted to different other entities, even across borders? And that led to a more macro finance way of thinking about this regulation, right? So again, these are some things that if you take a course in a more advanced course on macro finance regulations, banking regulations, these are some things that you would study in more details. But it's a good idea to just be aware of some of these issues because they often come up whenever you are thinking about this international financial systems.